This is Alpha. We continue to talk about the previous issue. Replacing emotional operations with standardized transactions, the priority of market factors in macro analysis. After talking about the capital factors, let's continue to analyze the emotional factors. Emotional factors are catalysts for short-term fluctuations. Although emotions cannot determine the long-term direction, they can make the market excited or panic in the short term, which is mainly related to investor psychology and emergencies. First, market sentiment and investor psychology, 3-star importance. When market sentiment is extreme, stock prices are prone to distortion. In March 2020, the new crown epidemic broke out. Under panic, the S&P 500 index plummeted by 34%. The stocks of good and bad companies fell together, and then rebounded rapidly in the short term. Such drastic changes reflect that investors' emotions have surpassed rationality, and this is also a rare opportunity to make money. Bill Ackman first went short, and then went long in this drastic fluctuation, making a lot of money. So market sentiment is an amplifier of short-term fluctuations, which often causes the market to make wrong pricing in the short term. It needs to be closely watched but not blindly followed, so as to avoid risks and find opportunities. When the market is relatively stable, investors' emotions may also cause the stock market to overreact, and this overreaction usually continues the general trend. For example, the market's excessive interpretation of a certain policy, or overly optimistic or pessimistic expectations of a company's performance, may cause emotional fluctuations. Such fluctuations may be driven by factors such as media reports and hot discussions on social media, resulting in a wide and lasting impact on market sentiment. Second, major announcements or temporary announcements issued by listed companies are of 2-star importance. News released by companies can ignite emotions. In 2021, Tesla released 4680 battery technology, and its stock price rose by 10% that day. In 2020, the stock price rebounded by 20% as soon as the news of Boeing 737 MAX's resumption of flight came out. However, the emotional effect comes and goes quickly, and the emotional fluctuations caused by company news only affect individual stocks or related industries. Its importance is lower than market sentiment. Third, political and government emergencies, 3-star importance. Although such events do not constitute geopolitical risks, they can quickly change investor confidence. In 2016, Trump was unexpectedly elected as the U.S. president. The market fell first, and then rose. The S&P 500 index rose 5% a month after the election. In 2021, China's antitrust investigation into the technology industry caused Alibaba's stock price to continue to fall. This reflects that it takes time for market investors to digest emergencies. In the early stage, the market seemed very emotional, and then slowly calmed down until the market made a rational pricing. Sudden political events have a more severe impact on market sentiment, but will not have a trend impact on the capital market. Its importance is equivalent to market sentiment. Fourth, technical indicators. In addition to the impact of events outside the market on market sentiment, the technical information of the market itself will also have an impact on investors' emotions. From a personal point of view, rather than saying that technical indicators are a technology, it is better to say that they are a kind of emotion. For example, when the S&P index fell below the 200-day moving average, it would have a pessimistic impact on the emotions of a considerable number of traders. In this sense, we include technical information that should belong to microanalysis into the factors that affect market sentiment. Although its importance is limited compared with other factors. The technical aspect is a weather vane for trading opportunities, mainly serving short-term transactions, reflecting market supply and demand and traders' psychological expectations. The importance ranges from 1 star to 3 stars. As an auxiliary tool, the technical aspect is of low importance under normal circumstances, but when the market is calm, its importance will be relatively increased. Technical indicators, such as support, resistance, MACD, and RSI, can help us seize the buying and selling points. For example, in 2021, Pingu's stock price fell to the support level of $120 and then rebounded, and Bitcoin rushed to the resistance level of $60,000 and then fell back, which reflects the influence of technical indicators on market sentiment. When the market is relatively calm, technical analysis can help investors capture short-term opportunities. The following are 7 commonly used technical indicators and their importance ranking. First is MACD, 3 stars in importance, which reflects the strength and direction of the trend and is suitable for judging medium and short-term trends. RSI, 2 stars, measuring oversold and oversold conditions, suitable for short-term operations. Moving average system, provides trend reference and support main position, simple and practical. Bollinger Bands, 2 stars, reflecting price volatility and potential breakout points, suitable for volatile markets. Trading Volume, 2 stars, confirming the strength of the trend, as an auxiliary tool for other indicators. Golden Cross and Dead Cross, 1 star short-term buy and sell signals, susceptible to market interference. The importance of the above-mentioned indicators of capital and sentiment will vary in different market environments, and investors should use them flexibly according to specific circumstances. The above content provides an overview of the factors affecting the market, and also makes some personal evaluations of their importance. As the saying goes, catch the thief first, catch the king. If you catch everything at once, you will often get half the result with twice the effort, or even lose money. In the stock market, the priority ranking of factors affecting the market should be the most basic homework for traders to do. In general, whether the direction of the impact of macro information on the market is positive or negative, there will not be much disagreement among traders, but the extent of its impact on the market is a matter of opinion. Perhaps many traders have not carefully sorted out the extent of the impact of macro factors on the market, but macro factors are the main force affecting the market trend. By analyzing macro factors, we can reveal the degree of risk in the market, and we can avoid the uncertainty brought by macro risks. Therefore, it is necessary to sort out the importance of many macro factors and deepen our understanding of them with relevant examples. Let's prioritize the macro factors. The general principle is that the priority of capital factors is higher than that of emotional factors. The specific rankings are as follows. First, geopolitical risk, 5 stars. Second, monetary policy, 5 stars. Third, natural disasters and epidemic emergencies, also 5 stars. Next are 4-star events, namely fiscal policy, regulatory policy, unexpected policies such as tariff wars, industry development trends and policy support. 3-star factors include the company's financial situation, profitability, growth, market sentiment and investor psychology, as well as political and government emergencies. 2-star factors include major announcements or temporary announcements issued by listed companies. Finally, the technical indicators. It should be noted that the above ranking is mainly to describe my macro analysis ideas. The ranking has no strict theoretical basis. It is purely personal understanding and there is a lot of room for discussion. Here, let me explain the technical indicators. I put the technical indicators as a large category at the last place, but it does not mean that it is useless. We know that it is impossible for major events to happen every day in the world, and it is impossible for a company to have major changes every day. The importance of technical analysis will increase relatively when there are no more important events. The shorter the trading cycle, the lower the possibility of other factors affecting the market during this period. This market state is a paradise for short-term traders. The vast number of short-term traders, they are all using technical indicators as an operating guide to gamble in the short-term market. They have a consensus on understanding technical indicators, and this consensus makes the effectiveness of technical indicators achieve a self-fulfilling effect. Therefore, technical indicators are very useful. At this time, as investors, we can pay more attention to technical indicators to capture short-term trading opportunities. For example, when the market is in a sideways consolidation stage, technical indicators can help identify potential breakthrough points and reversal signals. With this understanding, we can understand why active strategy trading and quantitative trading are basically short-term, or even ultra-short-term. We have never heard of examples of strategy trading based on monthly or even quarterly trading cycles. Next, we turn to the case of the U.S. stock market and use the following specific cases to illustrate how these factors affect the U.S. stock market in terms of capital and sentiment. Case 1. The Fed's interest rate hike in 2022. From the perspective of capital, the Fed's interest rate hike has increased borrowing costs, increased corporate financing difficulties, tightened liquidity, and the stock market has been under long-term pressure. From the perspective of sentiment, investors' concerns about economic recession have intensified, leading to panic selling in the market, and short-term fluctuations are obvious. Technical indicators show that the stock market has fallen below key moving average points, triggering more technical sell orders. The above factors remind us that it is best to reduce positions and wait and see when the capital side is tightening, the sentiment side is pessimistic, and the technical indicators are broken. Case 2. The COVID-19 pandemic in 2020. From the perspective of capital, the Federal Reserve cut interest rates and introduced a quantitative easing policy. The loose capital side supported the long-term rebound of the stock market. From the technical perspective, panic at the beginning of the epidemic led to a sharp drop, and finally the good policy benefits boosted market confidence. However, short-term fluctuations are very intense. Technical indicators show that after the V-shaped reversal, the main position was broken, showing a buy signal. These factors remind us that the support of the capital side, the recovery of the sentiment side, and the bullishness of the technical indicators can moderately build or increase positions. Case 3. The Sino-US trade war in 2018. From the perspective of capital, the trade war has increased the cost of enterprises, funds have flowed to safe haven assets, and the stock market has been under pressure for a long time. The uncertainty of the emotional side has caused panic among investors, and the volatility of the stock market has intensified in the short term. The technical indicators show that the support level has been tested many times, and the technical indicators show signs of oversold. These factors remind us that the capital side is very cautious, the emotional side is very volatile, and the technical indicators need to be confirmed. It is best to wait and see. Case 4. The tariff war in 2025. From the perspective of capital, a new round of tariff wars broke out between the United States and certain countries in 2025, resulting in higher costs for imported goods for enterprises, lower profitability, and capital outflows from the stock market, affecting the long-term trend. On the emotional side, as soon as the news of the tariff war came out, investors were worried about the deterioration of the economic outlook, and panic spread rapidly, leading to a sharp drop in stock prices in the short term. After the announcement of the tariff policy on Liberation Day, on April 2, the S&P 500 index plummeted by nearly 5%, and technical indicators showed that the sell-off caused by the tariff war caused the stock market to fall below the key support level technology. Related technical indicators show that there is further downward pressure. At this time, the RSI indicator entered the oversold zone, and the MACD indicator showed a dead cross. The above factors show that there is a great risk in the capital side at this time, the emotional side is very panic, and the technical indicators are broken, and there is great uncertainty. At this time, it is best to wait and see or reduce positions. Through the above cases, we can see the importance of capital and emotional aspects in stock market analysis. The capital side determines the long-term trend of the stock market, while the emotional side affects short-term fluctuations. The technical indicators in the emotional side provide trading opportunities. In investment, it is necessary to comprehensively consider these two factors to make wise decisions. Let's summarize. There are a lot of market information. We need to grasp the big and let go of the small. The capital side is the foundation of the market. Macroeconomic policies, industry trends, and company fundamentals are key factors that must be understood first. The emotional side is a seasoning. Short-term fluctuations are driven by it, but it will not determine the long-term trend. The technical indicators that belong to the emotional side are another tool that helps us capture opportunities. The priority of the above factors is very clear. Geopolitical conflicts, monetary policies, natural disasters and epidemics are all at the level of the sky is falling down. While factors that affect industries and representative large companies are second in importance, and emotional factors are ranked last. We have sorted out and analyzed the characteristics of market factors from the two major aspects of capital and emotions, and roughly determined their priority level of impact on the market. On the one hand, it allows us to identify the main risks in macro information and guide the timing of transactions. On the other hand, the inherent characteristics of some factors can provide us with some relatively certain investment opportunities. For example, the benefits of long-term capital inflows brought about by industrial policies can bring about a continuous upward trend in stocks of related industries. When emotional factors cause the market to fall excessively, we can take advantage of this opportunity to go long at a low level. I will talk about how to use it in the next issue. Okay, let's stop here. We will continue in the next issue.